Good morning. I'm Afsaneh Beschloss, CEO of the Rock Creek Group. Thank you so much for joining us for our quarterly global market discussion today. I'm in our Washington, D.C. office with three Rock Creek senior advisors, Dr. Alan Greenspan, Dr. Laura Tyson, and Dr. Liaquat Ahamed. With his remarkable 18.5 years tenure at the Federal Reserve as a Federal Reserve Chairman, Dr. Alan Greenspan needs little introduction. His views continue to command the attention of global leaders, central banks, and investors the world over. He has authored two books, The Age of Turbulence and The Map and the Territory, and is currently very hard at work on a new book on the economic history of the US. As always, we're honored to have him with us. Dr. Laura Tyson is normally on the West Coast, but we're very fortunate she's here today. The World Bank and IMF meetings are on starting this week, and she has been an active participant alongside some of our friends from the Rock Creek Group. Laura has served as chairperson and the director of the National Economic Council for President Clinton and was a member of President Obama's Council of Jobs and Competitiveness. And she was the first woman to serve as Dean of the London Business School and went on to serve as Dean of the Haas School of Business at Berkeley, where she's now professor and director for the Institute for Business and Social Impact. Last but certainly not least, Liaquat Ahamed has spent 25 years as an investment manager and CEO and CIO of Fisher Francis, Trees & Watts, and has been advising central bankers around the globe. He's the Pulitzer Prize-winning author of Lords of Finance. There's a lot going on in the world as we sit down today. In geopolitics, it's no longer business as usual. America's influence as a global leader is changing. We are negotiating with our top three trading partners and look forward to getting the group's views on that. NAFTA may disappear. China's influence is increasing. The European Union is fractured by Brexit and is facing tests from the Catalan and other nationalist movements. And there are unthinkable alliances being formed in the Middle East as Iran is fighting ISIS and as Saudi Arabia is beginning to work with Israel to expand its influence. And finally, Russia has shown that it won't miss an opportunity to undermine the US and its allies. In the US, markets appear to think that the Congress will have more success implementing tax cuts, and markets are hitting all-time highs. European economy is having an incredible time, and places like Spain and in particular, actually, the Catalan area, which we've all been following very closely, GDP growth is at an all-time high. In yet another reversal of business as usual, many emerging economies are experiencing increased stability, and the MSCI EM index is up more than 30% year to date. In fact, the flows to emerging markets are at an all-time high since 2009, at 50 billions having come in recently. So I think with that kind of backdrop, I'm very curious to hear Dr. Greenspan. In its latest Global Financial Stability Report, the IMF just came out warning that good economic times are masking very long-term risks, particularly the 135 trillion in debt among the G20 countries. The other concern that the IMF raised is that there are elevated asset prices in financial markets right now. Do you agree with the IMF's conclusions right now that investors are being too complacent about long-term vulnerabilities?
I do agree. That doesn't necessarily mean that it's now. I mean, we want to distinguish between people who are investing and people who are forecasting what's basically going on. That the longer term is a very difficult problem, I think goes with saying, but that is not the same thing as saying it's right around the corner.
Laura?
So yeah, I agree with that completely. I think that comment you read really talked about it as a longer term problem. I'll say two things about it. I do think that longer term problem should be having more effect, and it isn't, on the discussion in the US about tax cuts. It's not really a discussion about tax reform, it is about tax cuts. And we're looking at tax cuts that at a time when our revenue as a share of GDP is much lower than it was under Reagan and under Bush. So we're starting with a low revenue base for the federal government as a share of GDP, and the debt, of course, to GDP ratio has gone from 25% under Reagan to 77% now. So we need to take this debt into account as we make policy now, and I don't think we're doing so. I'll say one final thing. A lot of the G20 debt is also picks up debt in China, and I think we should treat that differently because of the very high savings rate in China, and because all of the debt in China is basically owed to China itself, and because the Chinese government has very different macroprudential and other policies to handle its debt. So I agree completely with Alan. I don't think looking at the market now, those kinds of concerns are reflected because markets are responding to rather good global economic climate. Maybe you'd like to talk about that.
What do you think, Liaquat?
Asset prices are high, but not irrationally high. And I think the high level of asset prices all stems from low long-term interest rates. Mm-hmm. That's what's driving it all. And if that were to change, you could see this whole thing begin to unravel. But there's no obvious reason why long-term real interest rates should begin to rise. Mm-hmm. There's productivity is low, productivity growth is low, inflation is not a problem. And so I think this benign environment continues for a while.
Can I ask you a question, which is, do you think that the normalization of Fed policy or UK Bank of England policy will change that? I mean, I
think it all depends on the pace. I mean, the striking thing about the whole normalization process mm-hmm. has been how measured the Fed has been in normalizing rates. Mm-hmm. And probably rightly so, given that there's been no inflation. Mm-hmm. Now we can actually have quite an interesting discussion about why have we had no inflation, and
or whether we are about to get it.
Exactly.
Yes, that's right.
Yeah. So that are we living in a little bit of a fool's paradise?
I'm afraid so. If you take a look at the cost structure of the United States, for example, you start off with essentially unit labor cost, mm-hmm. which is average hourly earnings divided by productivity. Mm-hmm. The last couple of months, it's taken off on the upside. Profit margins, which are all relevant here, are not moving one way or another, so that unit cost increase is going to show up in the price level. It's already in the producer's price index is started to move yesterday. I think just a question of time. It's got to happen, largely because we've run out of people. There's nobody left in the labor market. They're all employed in one form or another. And so that once this sort of thing starts, what I'm arguing is we're going from a state of stagnation to stagflation. In other words, stagflation has a very interesting history in the sense that when you're moving from stagnation to stagflation, that interim period feels very nice until it begins to get out of hand. And I think the issue of the longer-term debt is, remember that what debt is it's a rigid hold on flexibility. I mean, what a corporation does is to try to keep its debt down basically so that it has ability to function. Mm-hmm. And we're getting to a point now where things are not looking all that well, and certainly in the federal sector, which is ultimately a critical issue, because if that gets too bad, they spill it off onto the private sector, and that's where you have a problem.
There's a lot of discussion, we were talking earlier with Laura, that the traditional relationship between employment and inflation may not be there anymore. the way we were all trained as economists,
Certainly
about the Phillips curve.
Which particular relationship are you talking about?
Well, with, Phillips curve. The Phillips curve.
Are we allowed to say that on the?
We are-
The relationship between unemployment and inflation. The Phillips curve.
So do we think that that relationship may not be relevant in the future?
Well, it's never been relevant in the sense that it works all the time. I mean, I remember I had a big battle with a lot of my colleagues at the Fed in 1990 when the unemployment rate was falling like a rock, and it was getting under 4%, and yet there was no inflation.
Right, there was.
And the reason is that
Productivity
productivity
was so strong.
accelerating.
So
So
strong.
you can't talk about the Phillips curve without specifying what you're talking about with
The
respect to
conditions,
productivity.
And I think now we have a problem that we may be, is the traditional unemployment rate in a world in which, say, the employment population ratio has fallen and it does not seem to be going back to its average pre-crisis. So what is the unemployment rate the best measure of labor market tightness? That's one problem. The second problem is we believe that we're seriously mismeasuring productivity, but we don't know how much. Because how do you measure the productivity of free services on the internet? How do you measure the productivity of creating a unit of information? I mean, so I think the policymakers are, the Phillips curve always was a rough approximation to reality, and certainly the timing of the relationship was uncertain. When does the unemployment rate trigger inflation? When does it not? How long does that take? But now we have the problem that we may be mismeasuring labor market tightness. Labor markets are certainly tighter. I completely agree with Alan. We may be mismeasuring the ability of the workforce to actually create from labor market tightness wage increases because of the structural trend of automation taking away employment intensity, and we may be mismeasuring productivity. I completely understand, therefore, why Chairman Yellen will say, there's so much uncertainty. The thing I think we need to do is think, yes, over time, the normal relationship between labor market tightness and inflation will occur, but I'm going to go really slow.
Yeah.
Because
And not be preemptive.
And not be preemptive, right. Mm-hmm.
So you started talking about interest rates. So your expectation is that no major increases over the rest of this year and next year?
I actually still buy the low inflation story for the reasons that Laura was just describing. I'm acutely aware that there is a risk that all of this is wrong and suddenly we're going to get an uptick. But if I was a policymaker today, I would be willing to take that risk and to allow this growth more headroom. And keep interest rates low. So at the moment, the projection is that they're going to raise rates by 50 basis points over the next year. Mm-hmm. That's tiny. Mm-hmm. Mm-hmm. And I think that's a very reasonable forecast.
So the big elephant in the room is trade. Obviously, there's been a lot of talk about NAFTA. I was at a dinner with Mr. Trudeau, and he looked kind of rattled from his visit at the White House, to say the least. I know you were at the White House, Alan, and the big question is the U.S. is discussing its trade with its three largest partners. Right. Laura, you were talking about that earlier.
And discussing it in a very kind of, this is our demand, mm-hmm. and they're not really negotiable. So in the discussions with Canada and Mexico, and I think you may have seen the Trudeau after one of these discussions, what we're saying is within NAFTA, we want special procurement rules for the U.S. and special local content rules for the U.S., and this is just not going to fly. These are not acceptable things to the spirit of NAFTA, which is we created integrated North American. So I think NAFTA is at serious risk. And of course, the disruption of that to the US economy is substantial, particularly in certain sectors like automobiles. This is really going to threaten in very important supply chains, because so much of what we import from Mexico is basically they're adding some value to what is ultimately produced here and sold here and exported from here. So I really worry about that. I worry about, so we've instituted a Section 301, which is a unilateral U.S. trade action on China and intellectual property. And that unilateral trade action, we can impose much higher tariffs. We don't have to, we're going around the WTO here because we're saying, the Trump administration is saying that the WTO can't solve this problem, so we're just going to do it ourselves. And I say that these are our three largest trading partners, and they are three largest trading partners not only in terms of where we import, but also where we sell. These countries have a lot of capability of reciprocal or tit-for-tat responses. I just don't get it. I do worry about this.
Can I just raise an interesting issue which nobody wants to talk about? When NAFTA was put together, it was very purposefully skewed in the direction of helping Mexico.
Yes.
And the reason it was is that I mean, I was part of the negotiation, so I know what was happening, saw that an improvement in Mexico would really help everybody. And indeed, it has.
Indeed it has.
And why we're complaining here about it worked out to, well, they got a better advantage. Well, I should hope so. That's what we were trying to do. So I find this discussion rather bizarre.
But Alan, what people were talking about in the conversations I was at the Bank and Fund is we no longer are interested in trade agreements which make the partner better off. We are interested in assessing the trade agreement in terms of whether it makes us better off. And if it doesn't...
Well, let's put it this way. The answer is yes, but in this particular way, we weren't arguing that we're going to break down and give everything going on in the United States to Mexico. It was our judgment that if Mexico does much better than it was doing, and it was doing poorly, we would benefit. And this is not the question is not whether you're for it.
And as you said, we did.
Yeah,
But isn't the theory of the case of this strategy, the sort of Bannon nationalism, which is it may not be great for the economy as a whole, but it's going to be good for unskilled workers in the U.S. So their calculation is
Unskilled.
Yeah, their calculation is that a shift towards a more aggressive stance on trade and protectionism may not increase the size of the pie, but it's going to help our base.
The base, I want to make sure that you underscore that word because I'm not sure it's disadvantaged workers overall. No one cares about this policy is not paying attention to disadvantaged workers working in the service sector in big urban parts of the United States, okay? So there's a lot of...
Right, yeah.
I think that...
And talk about also impact on markets and growth, because if there's not growth...
Well, so I worry the following. So there's a lot of focus right now on will there be a tax cut, and I'm going to say cut because I don't think there's much reform in this thing, and will that be positive for growth? Let's say it's slightly positive for growth, okay? I'll give it that, although I will say because of the 10-year deficit situation, the interest rate increase may offset that. But let's say at least we start with a positive for growth. But I don't think we're talking enough about the negatives for growth that could be introduced if we pursue and succeed with this unraveling of our trade policies with our three largest trading partners. This is very negative for growth. And then I think that we really therefore need to look at the package of things. And I do worry that we may end up in a world where, yeah, we get a little positive from some. I'm for corporate tax reform. I think we really should have it. That could give, I think, a slight positive. But you could unravel that with the interest rate effect and the trade sort of unraveling effect. So that's how I think it might affect markets.
All this sort of wave of populism that we're seeing, we talked about the US, but looking at the Catalans, where they're responsible for a large share of exports, a large share of the GDP in Spain, but feel that they're paying a lot of taxes into Madrid, but not getting enough in return. Angela Merkel got re-elected, but at the same time, part of her coalition thinks very differently from her. The Irish, the Scottish are talking still about independence. So there's all these movements going on. The market is not looking at them as significant, though.
It's true.
Are they going to become significant, or will they just be fringe events that don't really matter on the market?
They have been very significant. Look, where this comes from is whenever you get a state of an economy operating over the longer run, like 2 or 3 years or something like that, you engender very significant negative reactions to democratic societies. And we see it in Latin America, and we've seen it for years, all along. Remember, we used to have all sorts of revolutions on the border with Mexico back in 1915. And what this is that populism is not a philosophy in the sense that communism is very, very specific, and Karl Marx was very good at analyzing. He just was wrong in the final conclusions. But capitalism is a very structured notion of how the world works. Populism is a cry of pain. Mm-hmm. I'm hurting. Somebody come along and help me. And this is what's happening here. For example, it really started with Brexit. Mm-hmm. And you can see it. What happened was, all of a sudden, when the productivity rates throughout the developed world collapsed after 2008, mm-hmm. they never recovered. The data show, for example, that the productivity rate in the United States, of course, is 0.5, 0.6 over the last 5 years or 6 years. That's the average of the developed world. The vast proportion of developed nations have output per hour for the most recent years of less than 1%. We had well over 2% for a very long period of time. This is a dramatic change in the standards of living. And that is filtering down through economies so that, I don't know which particular class of people you want to talk about, but at all levels, people are hurting, and they don't know what's causing the pain.
It really is at all levels. I mean,
but I agree with that interpretation. The one thing I would disagree with is that it's cyclical.
Yes.
I think this
it's
okay.
not cyclical.
This is something mm-hmm. that has been not going on just since the global financial crisis.
This is as far as you can map. It's human nature we're talking about.
So, but I think it's really interesting. So again, this came up at the fund bank discussions. I was in a series of discussions about the effects of globalization on labor markets, and of course, the first thing you have to point out is that it is the case that as Branko Milanovic and others have shown, that while the middle or even the bottom 99% by many measures in the developed countries has been made relatively worse off. Their expectations have not been fulfilled in the world of globalization. That is not the case of the growth of the middle class and the growth of the working class throughout the emerging world. Okay, so we've really had a period of globalization that has very much worked to the relative benefit of emerging middle classes and emerging markets. It's actually hurt, particularly I would say the middle skill manufacturing worker in the developed countries. And they're part of this base. And they also see the immigration being a threat to them in services and other things. So I really want to underscore that.
And there's almost nothing is there anything we know do we know what to do about that?
So let me say one other thing before I think it's an interesting conversation. The one other thing I want to say is, of course, we are the voter is misdiagnosing the importance of globalization. So but everybody kind of looks at this and says, let's just look at manufacturing, which is where this is really was concentrated in the middle. And it's basically been driven by automation, not by trade. Yeah. But that's you can't point at the machine. You can point at the immigrant worker or the foreigner who's being paid low wages. Now, what's a country that has done okay? Germany. What's a country that has done okay? Denmark, Sweden. There are continental European economies who have figured out a way to automate, to sell a lot to the emerging market countries, but also to buy a lot. And they have a very strong social safety net, which help people with transitions. The U.S. doesn't have it. Spain.
And great training programs, which we don't.
And great training programs. So there's a whole bunch of things which a few developed economies have done pretty well. And even there, look, we have to say that Angela's position is a bit weakened. You're right. So this is a long-term problem, and I don't actually see it being easily addressed, because I actually think, so let's say tax cuts. Let's go to the markets again. So tax cuts are expected. It's expected that they'll boost investment. It's expected that that will boost growth. How much of that investment will be job creating? Well, if a lot of it is basically skill intensive or labor displacing investment, a lot of companies can move to the technological frontier in digitization, not hire too many workers. So we may get some investment, but the employment effect may be actually quite small.
And major impact on which markets would do better and which markets could do a lot worse under that scenario.
Under the scenario of...
So you'll have more sort of bifurcation of the tech companies versus, or the new economy companies versus not.
I think you can look at the new economy company. I think one of the most interesting reports out there came out a couple of years ago from McKinsey, and they took an index of digitization, and they looked at firms and sectors on the basis of degree of digitization. And they found that within a sector, the firms that were the most highly digitized on a whole bunch of things were actually doing much better in terms of productivity, profit share, labor costs, everything, okay? So now I think you can look at firms and you can look at where they are relative to what they might do with increased investment to become more digital in everything they do. I think I would look there. I actually do. Stick with the tech companies, but look for the companies that can make progress with digitization. Yeah.
So one of the things that Alan said long before anyone else really was worried about it was watch Korea. I think it was over a year ago in one of our calls. North Korea. And yes, you said that. I remember asking you long before it was in the newspapers, what is the biggest risk facing us? And you said North Korea. Obviously, it still remains a risk. At the same time, the relationship between North Korea, US, and then the whole Chinese role in it is getting more complicated. This morning, the news was that the US is going to, at the moment, maybe slow down the capital increase to the World Bank until the World Bank re-looks at its lending to China, China being the largest borrower from the World Bank. So there's a lot of moving parts there.
Because China is our most important ally in terms of dealing with North Korea.
So this sort of complicated web, do we need to worry about it? I mean, you were ahead getting us to worry about it. What should we do now? Should we be even more worried? Or
the first thing I would do is start to worry. That's an easy thing to do. I wouldn't, look, obviously, go back and look at the beginnings of World War I. What was fascinating about the period is nobody thought that a war could take hold. Why? Because they would run out of gold and they would not be able to fight.
Right.
And that, to be sure, Europe was in a little sort of disequilibrium, but nobody took it seriously. Once a war starts, it builds. You can't, in other words, start a war and then say, hey, this is not a good idea, let's stop. Because too much has already been committed. What bothers me is exactly that issue. That is, we can sort of be fighting with each other at the edges and say, well, nothing is going on that's very important. It's all just a bunch of talk, and the problem is that somebody will do something stupid, and it is very difficult to reverse it. And I don't know how this is going to work out. I do know, and one of the concerns I've always had about North Korea is that Korea, both North and South, are people with very technically skilled abilities. And I mean, for example, South Korea came up, it was devastated. Well, look where it is now. And North Korea, whose standard of living overall is extremely low, nonetheless has a sufficient number of intellectually capable people to basically figure out, by one means or another, how to get their military moving to the extent that it is moving. I mean, everybody is shocked at how fast it's occurring, but you only need a handful of people to make the judgment, to figure out the mathematics of a lot of different relationships. I mean, what do you do with a missile, how you direct it? But as far as I can see, the real danger here is small, minuscule little problems which fester into something very much larger. I don't see it as a probability that's particularly high, but if it's not close to zero, I'm nervous.
So on this one, I would ask that I'm worried that the technical capabilities are exactly as you say. They're moving very fast. There is a significant part of U.S. foreign policy thinking, both within the administration certainly, and even in the Congress, that we have to stop North Korea from becoming a nuclear power. And then there's a serious view that too late, can't do that. All we can really do is contain it and management, and we better stop making policy on the grounds that we can divert it, stop it, destroy it. I think this is a containment issue and that's why China is very important for many, many reasons, but I think we would be better off just accepting that because it's a reality and then saying what should our policy be under those circumstances.
There's, by the way, also talk of maybe cyber war.
Well, cyber war, I think, is going on.
Soon, but
cyber war is going on.
Significant,
that would be a good thing,
because there is like
because people don't die. But yes, there actually have been reports, and you can see. So after the Puerto Rico disaster, people pointed out that there's some evidence that various countries are working on policies to undermine the electricity grid of other countries. Okay, that is a massive cyber warfare attack. Okay, and that's the kind. I agree that there's the probability of those things is rising, and it's very unnerving, right? But the truth is, to get back to markets, markets seem to be paying attention to virtually none of this. Okay, I have to say that we all can sit here and talk about these things, and the investors are saying, I don't think it's going to happen. I
think the dilemma for markets is, what do you do when you have a very low probability disastrous event? How do you incorporate that in?
Well, that's the fundamental issue of policy, is how to weight various probabilities. And we've got very few tools which are sophisticated enough to do that as well as it should be done.
I mean, I don't remember the Cuban Missile Crisis because I was a kid, but I don't think markets went down that much because people said, actually, I've got a lot more to worry about than the value of my portfolio. That if this whole thing blows up, there are many more important things.
Well, the only exception to markets being so much is now interconnected in terms of financial data and everything in finance being now.
Yeah,
so if you have a major threat,
I think I'm in disagreement with the three of you on one issue. I think we have a bond market bubble.
Okay, let's
in other words,
talk about
remember that low interest rates means that the price of the bond is up here, and the earnings are down here, and if we crossed out bond and said stock, we'd all be shaking.
The only difference is a bubble usually occurs when you're buying something, thinking it's going higher in price, and you're going to sell it to a greater fool. And I think the problem with the bond market is, I don't think that's why people are holding bonds. No. It's because they can't think of what else to hold.
It seems relatively okay.
But remember, we are now, U.S. Treasury securities are yielding the lowest level in American history, going back to 1789. Now, you have to ask yourself, what causes interest rates? Interest rates are a subcategory of what economists call time preference. It's a built-in psychology of how we discount the future.
Right.
In other words, if we're standing in line at one of those crazy round-the-block type of things when an iPhone came out, and you're saying, well, here I am at the end, what would I pay to be able to go up front? Those are time preference types of things. But it's a constant. I mean, and the most visible constant.
But is it a constant? Because we're dealing with a global market, and you're dealing with global time preference.
I agree with that.
So you've got a whole lot of people who saving massive amounts.
Yeah, 45% savings rate in China. Why are they saving 45%?
And where are they going to put it?
The interesting thing, by the way, is some of the sovereign funds are saying what Alan is saying, and they're not adding to their bond portfolios.
Okay.
Yeah.
They're buying real assets.
But that suggests it's not a bubble in the sense that it might be the case that people are looking at going, this is about as high as it's going to go. I might stabilize my position on bonds.
Well, they can't sell it.
But that's a sign that it's a non-bubble to me, that instead of adding, in the expectation it's going to go up.
Well,
some of them
anyway,
have my choice.
Well, I'm just basically saying that interest rates have been stable, going all the way back within a narrow range. Ancient Greece had long-term interest rates, to the extent that they were long-term, in single digits. And we have Bank of England data for every day since 1694 on their discount rate. And until Britain ran into problems at the beginnings of the Attlee administration, there was not a single day in which the discount rate out of the Bank of England was greater than 10%. And that tells you something about the stability of this. And when you get down to this lower level, you should be concerned largely because the range has never been.
Here's a possible scenario, which is that people are holding on to bonds and they've been lulled into complacency because every time we have told them in the past that interest rates are going up, they go up briefly and then they don't go up. And so no one actually quite believes the risk associated with bonds.
As soon as they forget the risk, then you're in real trouble.
And the dilemma is, at some point, when rates start rising, everyone heads for the door.
That's the danger.
And you get a sort of self-fulfilling prophecy.
That is what's called a bubble.
That's the unraveling of a position. Whether it's that's a risk.
That is, it
is
isn't. It's
big risk.
Yeah.
No, I think we all agree.
Right.
I think we all agree.
Moving right along, I think one of the other things that has that happened in Washington recently is a new Fed member who is in charge of regulation, including regulation of banks. With a lot of talk that there'll be changes in bank stress testing, in the Volcker rule, maybe Dodd-Frank. Do we think that's going to happen? And again, what kind of impact will that have?
I've never been a fan of the Volcker rule, so I would be cheering if that. To try to determine regulations based on the intention of why someone holds something is so, you're chasing, you're chasing shadows. So I do think that Dodd-Frank went too far it was a Christmas tree of
Yes, and the Volcker ornament was added quite late, actually.
Yeah. And so I think the whole system would benefit from less regulation, smarter regulation, but more onerous regulation in certain areas. So I'm going to, Alan has talked about capital requirements as being the crucial regulation. Do I think that will happen? Do I think they'll increase capital requirements? No. But that's what they should do. They should.
They actually did in part.
They did.
Oh, yeah.
Yeah, they've
No,
done
but
it. They've done
will
it.
they
But-
do more?
Well, you know something, if you go back and look at the history of the rates of return on equity capital in commercial banks, and we have data going back to 1869, when the act of that period created the control of the currency, and we have annual data. The rate of return off equity in commercial banks has ranged between 5 and 10% in virtually every year back to the beginning. And even during the Great Depression, it went off for a while, but then came back very quickly. And it is still there. Now, this is the reason that I think that if the rate of return on equity is a constant in commercial banking and in financial intermediaries in general, then the question is, what happens if in that context where that rate of return to equity is flat, you introduce a significant increase in the amount of equity to assets, which is what, now looking back at the 19th century, that ratio was going straight down. But if you do that, what history says is that if you stipulate that the rate of return on equity is going to remain unchanged, and then you introduce a significant increase in the capital requirements, what history tells you is that the system will adjust. I mean, basically, once you state those two propositions, you've stated the third as well, which is basically the rate of return on assets. Now, if that is indeed the case, I don't see any reason not to go to maybe 30% required return, because at 30%, the chance of contagious defaults falls very dramatically.
So what you're,
And contagious defaults are what we're concerned about.
right.
The question
that's
is
right.
is that politically
I think
likely?
Well, let me put it to you this way. If you saying, is everybody saying to me, oh, that's a great idea, let's try to do it. No.
Okay.
I think the discussion of the new Fed board position is really about loosening regulations. Certainly, there's no discussion of raising the capital requirement. I think.
The question is,
But
why
we've done
not?
some. We have done some. I think certainly. I think one of the things we haven't talked about enough here is basically a good news thing. So the U.S. banking system is really in really good shape.
Yeah.
It's in really good shape. The system is more stable. A lot of the things that were in Dodd-Frank have been effective. I think that one can debate the Volcker test. As I said, that was put there late. I actually think the other one that was mentioned, which I think we should preserve, and I think the Fed can preserve it, are the stress tests. Because the stress tests helped the banks as they were building up. What's the level of capital and what's the allocation of capital and what are you allowed to do in order to make sure you hit the stress. So could there be more transparency in the stress tests themselves? Probably, because I don't think the Fed reveals in any way to the banks what they're kind of looking at. So that might be, but I actually think the stress test has been an important part of the soundness of the system, getting strengthened. So I would say it depends what they go after. I think stress tests are really important here.
So no increase in capital requirements.
We don't think it's, I think we all agree
would
that,
love to
that
see it, but
it's
it's not gonna
sensible,
happen.
but we also don't think it's going to
I'm
happen.
saying that you could eliminate all
Everything else, all the
you could
other.
Yes.
all that hodgepodge of regulation. I mean, Dodd-Frank is fascinating to read
Yes.
because it sounds so bizarre. I mean, how many pages is it? I mean, I couldn't lift the book.
No, thousands.
I mean, it's
Instead of a capital.
you know, basically, what Dodd-Frank is it's instructing through the law that what certain agencies ought to try to do. Now, you can't do things that way because the agency then proceeds to fuss around to figure out how to do what the law says. There was only one hardwired rule in Dodd-Frank, and that is that essentially the credit rating agencies have to take certain responsibilities for what they give you with respect to ratings. So what happened? The first, I think it was Ford Motor Credit came out the day that the bill was signed, and because of the SEC, it's an asset-backed, and you need a credit rating. Nobody wanted to give them a rating. That tells you something about the bill.
Well, so I just want to say on this score, because I remember Alan and I, when we were both in government at the same time, this was also a discussion of whether there should be some consolidation and better coordination among the agencies that oversaw the financial system, okay? The Fed's power has definitely started to increase then under Alan. It certainly increased in the post 2008. Okay, so the Fed is a much more important regulator of the stability of the system, but we were not able to eliminate any agency. In fact, I think we didn't eliminate one agency and added another. So we ended up net the same place. Okay. And they do. There's silo effects, and within Dodd-Frank, different agencies have different roles. I think the good news here is that the Fed's role has been strengthened, and I worry a lot about the independence of the next Fed chair. Okay, that's a key issue. That's a key issue for markets. I don't have any particular insight into how that decision is going to be made, but we actually have, I guess, identified 4 candidates. I would suggest that all of the members of the marketplace look at what they expect from each of these 4 people, because I think the Fed is really important here in terms of both independence for macro policy but also for regulatory policy.
Absolutely.
Yeah.
And I think as you were speaking, Laura, when you said that, you know, there's the regulation that exists on the banks, at the same time, so much lending went to non-bank entities.
Non-banks,
There's
and
so much opportunity now in what we call private lending.
Yeah, private lending.
And it has exploded.
Mm-hmm.
And it is generally a non-regulated area.
It's generally non-regulated.
So
That's
you're
right.
sort of back to the same place.
You're back
going
to
back to what Alan says, which
Yeah.
is good regulation, but less, maybe more effective.
Or a different place, because this was a big debate all through the Dodd-Frank, which is how much do you regulate the non-bank sector?
You know something, what I never got out of Dodd-Frank is what's the conceptual framework that underlies that particular bill? What is it that they were trying to do?
They were trying to make the financial markets more stable.
Well,
I think that's what they were trying to do.
They tried a little bit of everything.
And they tried a little bit of everything, maybe
look,
that's right.
my problem with most regulation is that it's a patchwork of various things, because as you know, it goes through the congressional process.
Yes.
It's a wonderful thing to see.
Yes, no, I
But
completely
I'm not
agree.
sure I'd use the word wonderful.
Well, small W.
But in that whole process, I think it is it's correct to say that whenever they approach the issue of more regulation or some regulation of the non-bank sector, they moved away from it. And then there were a couple of high-profile sort of pushbacks from some of the insurance companies on, what is it, the Office of Financial Assessment that was included in the Treasury. That's part of the Financial Stability Board of the U.S. government. And they can't, we have just not solved that problem. So in the part of the capital market we're talking about, and it's not just here, it's globally. It's globally. It's globally. So that would suggest that the next crisis, whenever it comes up, as the last one actually started not in the banking sector, but the banking sector was badly affected by it. This time the banking sector is built up enough resilience, I think, stress tests and all the rest, that they can not be affected, but we haven't addressed the issue.
So let me ask you, you've said the US is in much better shape.
The banking system.
And it certainly is. What everyone says is if you were looking for a banking crisis, you should look at China. And on the one hand, you have a group of people who say, you look at the macro numbers and they are crazy. On the other hand, you say to yourself, well, this is a system that's heavily controlled by the government. The government is the borrower, various agencies of the government are borrowers, lenders, and that this is not going to behave. The Chinese financial system under stress is not going to behave like the US financial system under stress.
Right.
They'll just guarantee the whole business.
That's in effect.
I think that's
what
right.
people are saying.
That's what's assumed, right?
Well, yeah,
That's
look,
what's
for example,
assumed.
a significant proportion of the debt is corporate debt by state-owned enterprises.
The problem
And,
debt is there.
So you're lending, a state-owned commercial bank lends to a state-owned enterprise. It's got the same shareholder.
Yeah,
Right. And you're not going to have a run on the system in the same way.
They're not.
Absolutely.
No. And they also, their housing market, where oftentimes some run, the last one for us started there, they also regulate that in a very different way. So in terms of mortgages and things like that. So in terms of control of land and basically the control of the housing supply. I think it's a mistake for us to look at debt GDP ratios and say that China is headed for a crisis. I actually think you have to look at all the tools, and I think they have slowed down the generation of new credit, but they did a non-performing asset correction back at the beginning of the 2000s. It was massive, okay? Yeah. That was basically the government coming in and saying, okay, there are a whole bunch of non-performing loans in our banking system, let's clean it out. They did it once, they can do it again. They can do it again.
Without provoking a run.
Right, without provoking a run, right.
And Liaquat, as you were saying, there's been a lot of talk about the debt issue and the housing debt issue overhang and the potential of China having serious problems, growth and markets. In last year we had that, then beginning of this year we had that. But in effect, the Chinese market has done so extremely well this year. The Hong Kong market has done extremely well. Their tech companies have done incredibly well. And there's still a lot of growth left in there.
But ultimately, the Chinese growth strategy has not changed dramatically. They are still building a lot of houses.
They are.
There's still an enormous amount of infrastructure spending driving this. It's still credit driven. And so the idea that they were going to reform and restructure, they've done so at the margin. So the question, now one side of me says, well, there are so many Chinese that frankly they could build as many apartments as they wanted, and they may be empty for a while, but they will eventually get filled. Or they can build so many airports and maybe they're not, no one's using them now, but one day, if you have a low enough discount rate, it all makes sense.
So one of the things I saw,
they're adding a lot to the social sector, health, education,
first of all, I think they're doing
a
little. I would say they're doing a little better, a little more than you're saying in the following sense. I think if you look at, so they said they wanted consumption as a share of GDP to rise and investment to fall. That has happened. The investment rate is still much too high, but you've actually seen that line cross, and that was people thought they can't do it, they did it. The services sector has been the major drive. So consumption has been the most important driver of growth in China for the last few years. And within consumption, it's mainly been consumption of services. So that is really quite remarkable. That is a shift. And they actually, to show that they can sort of do things that no one else seems to, they basically said, okay, we do have an overcapacity problem in some of our basic industries, so we're going to shut it down. They actually shut down, reduce their industrial production of things like cement, steel. So
added to clean energy.
Yeah, and added to clean energy. And then I was just saying, last night I happened to be with Afsaneh at a wonderful discussion of the World Resources Institute, where they showed some of the amazing alternative energy technology that cities can use. I personally think China has a huge infrastructure investment opportunity to take those completely smog-ridden, pollution-ridden cities and transform the infrastructure. And they say that they're moving to an alternative energy future. They've set a date. I think they can do it, and I think that will require a lot of new investment, but I applaud that investment.
Well, you know something? I'm not altogether sure.
Okay.
Let me tell you why. Back in the 1990s, when Jiang Zemin was president and Zhu Rongji was premier, and essentially running the economy.
They were running the economy, certainly.
You could see coming from Mao all the way up to Jiang Zemin a very significant liberalization. And what they were setting up was a significant capitalist society and economy.
Yes.
Now, that stopped after Jiang Zemin. You know, they have the 10-year periods. I don't know what's happening, but with President Xi, this is a continuation of the reversal of what's going on. And what, you know, I saw the issue that was raised yesterday about the Chinese government wanting a piece of the action in some of the high-tech firms.
Right.
Yes, so there have been,
That's
yes.
a little bit nervous-making.
I certainly, so the growth of the
And
high-tech
that's just
firms.
in the, by the way, as their elections are not, their national congress is
national
meeting
congress,
in
their national
next
congress.
week on the 18th of October.
Right. And that is
So
coming
that's
to
kinda
some
interesting.
extent from things like China Telecom, the state-owned companies that actually are having their businesses eroded by the Alibabas and Tencents of the world. So I do think that, but by the way, I also think in the United States, the issue of how you regulate these massive social networking platforms is going to be a regulatory issue here. It's already because of the use of the platforms in our election, I think. And a lot of people are worried about market share. I mean, you know, basically the market power of a company like Google or Alibaba or, you know, those things, maybe you do actually need some regulation. So I understand that certainly the current leadership has certainly slowed down, if not stops, the reform of the state-owned sector. That started to happen in the great financial crisis, because to do this big, massive investment
Yeah, you know,
They relied on them. They relied on them.
China 20 years ago was the most vibrant capitalist economy in the world. They're still there, but it's going the other direction.
I don't know. I think a lot of the tech sector people I know would say it still is the most vibrant, that it's the place where basically they're not, in the tech sector, it's mostly private and they're mostly sort of standing back. Now, then they might come in as they get large and begin to regulate them, both for security reasons and competition reasons, and because they want to share the action.
You know something? Chinese leaders are worried about the private sector becoming too powerful.
Well, these are very powerful players. Yes, they are very powerful players.
I think on that note, I'm going to thank you all. It's a very interesting time in the world of geopolitics, in the business world, in the markets. And wanted to thank you, Dr. Greenspan. Thank you, Laura. Thank you, Liaquat, for joining us today.
Thank you.
Thank you.
Thank you.